We are back. It's still Sunday, February 1st, 2026. You're watching First Call. This is Tasty Live. I'm your host, Chris Vecchio in New York. Ilya Spivak back in San Francisco. Ilya, I hope you had some safe travels. I assume they were safe. You're still around on air, so I assume that's
I did make it.
Of you. You did make it, okay.
I did make it. It was a circuitous path. I had to spend the night in ORD. My flight got canceled. But I am here, and I'm back.
Good
also,
to have you back.
Our viewers will be happy to see that I've re-expanded back into the frame size that they're used to. Some folks were commenting that the wide lens of the studio shot implied I'd shrunk.
All right. Well, no, I don't think that's the case. Ilya, last week while you and I were out in Chicago, and it was a great week to see everyone in the studio. Great office, by the way. We wish we could be out there more. Hint, hint. I will note that it was a week that was wild for other reasons. As we get the show started up here, we're going to do a bit of a week in review, the top line futures, the best and worst performers in individual stocks. Likewise, where volatility rose and fell the most. We're also going to see what's coming down the pipeline this week, Ilya, in terms of those earnings. What's happening geopolitically, because there was an event we were watching in the Middle East this weekend that did not transpire this far. We'll also talk about that central bank calendar that's coming up, because there are 3 big ones in the coming days. Finally, Ilya, you and I will talk about our top trade setups for the week ahead, what you're doing in silver, how I'm licking my wounds there still, how you and I both will be nursing what could be a losing position in oil, and maybe FX yield some chances that we could take a shot on maybe $1, given what's happening with the BOE and the ECB. Of course, non-farm payrolls too. So it's a very jam-packed week. We're going to try to cover it all here over the next 30 minutes or so. But we are going to look at the top line futures, because over the past week, we did see a pretty dramatic pullback in our, not really the equity markets per se. The S&P 500 over the past week was up 0.29%. Your NASDAQ was down by 0.27%. The Russell, a little bit more extreme, off by 2.05%. The entire conversation starts and stops with what happened in the metals, where both gold and silver, looking back in the history, I suppose you could mark it off for each the worst single day performance since 1980 for the metals. Silver down, that is, yes, no, just making sure my chart's correct. Yeah, 22.5% over the course of the past week. Gold was down 5.4%. Your platinum, which had been high flying as well, that was off a healthy 22.6%. My mistake, 22.6%. Copper, the survivor, down only 0.4%. And we can have a discussion there about what that means, because this doesn't seem to have been impacted by the run-up the way the other ones were. Beyond there, of course, it was a week where the dollar got clobbered, because we have ultimately it's another weekend of Trump stuff last weekend. But this weekend, we're seeing that while we're moving into a Kevin Warsh nomination, the dollar itself pulled back a bit, then bounced at the end of the week. The Japanese yen was still up. The Canadian dollar was up. The Aussie was up. Everything was up. The dollar was down by 0.56%. But the Warsh nomination coming on Friday, sparking that big move that we see in the metals, ultimately helping the dollar recover some. Ilya, last week as well, I'm thinking about the top equity movers here. But before we get there, I'm curious. I know that you were someone who was short silver. It looks like that we didn't have anything coming out of the weekend with respect to Iran. So it's possible that we see a little bit of a continuation here downwards in the metals as we get some of these opening quotes in right off the bat here. And it looks like silver is opening lower by about $1.50. Gold, likewise, maybe another 70 or $80. What's the plan here moving forward now as someone who was short and caught this move to the downside?
I think for me, the plan is not to get overly jittery and just to let the price action wash its way into whatever sort of equilibrium it's going to try to find. I mean, we can see here that we landed in similar sort of former, I suppose, resistance turned support. If you look at the beginning of the year, there's those former highs right around where we're coming into here. And so it is a logical place to test. It's not necessarily a logical place to have conviction until the price action signals as such. So maybe we break it, maybe we don't. I don't have any illusions of catching the absolute bottom in this move. That'll be fine. I don't need to do that. I'm looking for the same sort of thing that I was looking for when I was getting in. I didn't anticipate we were going to have the biggest one-day sell-off in silver in history. I just thought the price action looked exhausted, as we discussed. And incidentally, I was caught on the wrong side of the move too, because I was still long gold. Now,
Sure.
I got out of that position quickly. My actual sort of macro bias is still very constructive for both gold and silver, and mostly gold. But silver looked like it was overdone on speculative froth grounds. And so what that exposure turned into was this. I don't need to catch the absolute bottom. This is not some sort of macro-induced idea. If I see this thing start to look like whatever wave of selling has been exhausted, I don't necessarily just plan to get out. I have a good mind to flip the trade the other way, because I think the trend still favors gains ultimately. The macro backdrop still favors gains. But
well, speaking of that backdrop, we do have
Maybe
another
not yet.
hurdle to run into, because the CME put out a margin hike alert across all precious metals products. Effective February 2nd, maintenance margins are set to jump for gold futures to 33%, silver futures 36%, platinum futures 25%, palladium futures 14%. Obviously, what's happening in the volatility here is driving the news. It's not unusual for a clearinghouse to raise margins as prices go up and volatility goes up, and that's exactly what we've seen over the past few weeks. We've erased a good chunk of all the move that we've seen thus far in 2025 in some of these products, Ilya.
Yeah.
But the underlying fundamental drivers haven't necessarily changed. The market is perhaps going through a period where it was broken and overstretched and overleveraged, and certainly didn't see. I've seen some people try to rationalize this as a 10 sigma move or whatever that is. But you know what? A loss is a loss. As a trend follower, this trade for me stings, but this has been a trend we've been following for months. And at some point, as a trend follower, you're going to take a trade in the trend that just doesn't work.
And
so
that's how you know it's over.
And you have to lick your wounds and move on. Now, as for me, I'm structured in such a manner that there's so much time on the board that if we can wash through another maintenance hike episode like we did in December, which lasted a few days, and then we continued to rally, perhaps we find some stability and make our way up. Otherwise, I'm eating things that are going to be close to max loss, as is Ilya. But that is, of course, the nature of taking the trade. Comfortable with that outcome either way. It just didn't foresee it happening in such a manner. Ilya, these are the top macro movers last week. We have a little bit of weakness here in stocks on the other side of the weekend as well, as we get opening quotes. S&P down more than 0.5%. The Nasdaq off by 0.8%. Our Russell is off by 0.6%. The liquidation in Bitcoin, though, has to draw our attention, because Bitcoin's off 8.1% after I saw yesterday all over Reddit more than, again, $100 billion in liquidations going through over the past 24 hours. Ethereum off 14.38%. So something in almost like a liquidity sense is happening when you take a look at the markets here. People are just taking risk off the table. The metals are down, the stocks are down, the crypto's down. Can we even say we're hiding out in bonds? No, the bonds are down too, Ilya. So it's a rough Sunday open where there's not really any sort of reprieve anywhere you look. But I think that you and I have been looking for something to trade on the long side in Bitcoin for some time. I know that you're taking a little bit more of a flexible worldview in 2026, new year, new you, which is not just exiting a position when you feel like it's wrong, but going full bore and flipping sides.
Yeah.
So you've been someone who's been getting on the other side of these things that have been breaking down despite having bullish premonitions otherwise. How do you feel about the crypto markets here now after we look at these just dismantling on the other side of a Saturday and Sunday?
Yeah, well, I mean, in the spirit of moving a position into the opposite direction when the market seems to signal as such, I got back short Bitcoin about 3 days ago. And that was on the break of this most recent range, call it something like 84.6, 84.7. And at this point, I'm sitting short. It's starting to make some newer lows, but it's approaching these bottoms from back in April of last year. And that was a pretty significant spot. That was after a sell-off.
That the April lows that were found in Bitcoins when the S&P trades below 5,000, and now the S&P is near 7K. Isn't that odd? That feels like that's not how the story's been written in recent years. It's always been, if stocks are bouncing up, then Bitcoin is, hammer time.
Well, so this is really the interesting thing. There's sort of the camp that says Bitcoin is higher beta risk sentiment, right? It's stocks, but more volatile. And then there's the camp that says Bitcoin is digital gold. It's a safe haven. It's an anti-fiat asset. And what's interesting is we've seen periods where both of those assessments might have been shown as working when you looked at the correlation and sort of the cross-market price action. In this environment, it's neither of those things.
Right.
It is not a risky asset in the sense that it follows sentiment because it can't rally on that. It is not an anti-fiat asset in the sense that it looks nothing like gold, even after gold's washout. So when you look at what Bitcoin is here, it's really just an asset that with its price action is telling you, I don't want to go up. I don't care what the excuse is. I don't want to do it. And that to me is the most bearish thing of all. When the price action diverges from what have been supportive forces before, believe the price action.
Believe the price action because that's what you get paid on. The April lows near 75K are very much in focus after what's been a few rough days for the crypto industry. We've had the legislation that was up in front of Congress really have a topsy-turvy few weeks. Brian Armstrong, the CEO of Coinbase, of course, came out against it. Jamie Dimon of JP Morgan last week was out there.
Let's coin that one. That's good.
Chiding Brian Armstrong and the crypto industry for their tokenization bill for the stable coins. It seems to be in disarray, right? And with the macro narrative having shifted and just these concerns going on and on, well, with the liquidations now in the metals and the weakness that stocks are facing here, part and perhaps because of the Warsh news, dare I say?
Could be.
Ilya, that was the big news on Friday that more or less sparked this big pullback in silver. Although I got to say the margins shifting are probably a big part of it too.
Yeah.
And if that is what led to the decline in 2011. Okay. But again, we go from like a 24x leverage environment in silver to 6x where we were at the start of the cycle. And now we're getting down to like 3x.
Mm-hmm.
So there's, again, a little bit of washout, a little bit of tightening. I'm not sure it has the same effect net long term. We can probably find some stability. So I'll be keeping an eye on both of these metals. Sure. I'm thinking about what happened with the Warsh nomination, though, because one of Kevin Warsh's, and you and I went back and forth a little this on last call.
Yeah.
People are really honing in on the fact that Warsh is in big favor of balance sheet reduction, right?
Yes.
Balance sheet reduction from the Fed would effectively mean lower asset prices. And so a Warsh nominee, while maybe it comes alongside lower interest rates, a Federal Reserve that's draining liquidity from the market wouldn't necessarily be a good thing either. After having a few days to digest this, because this coming week, as we think about what's now coming down the pipeline, I do want to start off with the central banks that are coming in this week. Last week was about the Fed meeting and them on hold, and then the Warsh nominee. This week we have the RBA from Australia, we have the Bank of England, we have the European Central Bank, all giving rate decisions. These are all central banks that lent some support to a public letter offering, they're standing on the side of Powell and Fed independence.
Yes.
It feels like with the Warsh nomination now hearing from these central banks, this Warsh nomination saga really is just getting started and is a catalyst that we should be looking to still yet in the days ahead.
Absolutely. It's an interesting sort of thing that we got last week because on the one hand, we got a Fed that really made a point of saying as little as possible and trying to keep their options open and not over-interpreting, not over-signaling, because they really are in a tough spot. They're looking at an economy that looks fairly strong, a labor market that's maybe not giving the hiring, but not for economic reasons, which is a very difficult thing for the Fed to solve. If people aren't hiring because they're unsure what AI is going to mean, what the trade war is going to mean, they're not firing. The economy is not weak. This is sort of the paradigm weirdness that Powell has described, where you cut rates to stimulate the economy to go faster, and in that environment, for people to hire. But the economy isn't going slowly. In fact, it's accelerating. So the not hiring is not that. So whether you can really fix that with lower rates is very much a debate. So the Fed is really trying to keep their options open and not really do anything too fast, especially as the price of oil goes up. Inflation risks follow that outcome. So in that environment, to announce that what you're going to do is nominate Kevin Warsh, somebody who is seemingly the least Trump approved of the possible candidates. The president made it very clear he wants a dove. Kevin Warsh has a decades-long history of being a hawk, even in instances where it might have made sense to be a dove, like when he was still calling for very hawkish monetary policy in the run-up to the 2008 crisis, reasoning that, look, the dollar is falling, crude oil is rising, that's inflationary, you should raise rates. But of course, those things were happening because capital was fleeing dollar assets because of a looming crisis, which thankfully the Fed diagnosed correctly. When the ECB misdiagnosed this, they were raising rates into a recession, which hurt that economy tremendously. It's a big mistake for ECB's Jean-Claude Trichet at the time. So it's an interesting choice here to pick this particular nominee. Of course, we still need to see the charges against Jay Powell dropped for any of this to move forward, because Tom Tillis on the banking committee will not pass this nomination forward, or any nomination, until that issue is resolved. And he's not running for re-election next go round, so he doesn't care. And against that backdrop, we're going to get at least one central bank that's expected to hike this week. The RBA is on the menu to hike, and that's not the first hike that they're anticipated to do this year. They've got 50 basis points that the markets have already baked in. So we're in a situation here where the dollar might see a lot more headwind just on relative yield grounds. Now, we also have the ECB and the BOE this week. The situation is more dovish there. The Bank of England is expected to hold, but they have at least one cut on the menu for this year. The ECB is expected to do nothing all year long, and that begins with this meeting. But if the bias at the Fed is at least some cuts, then these central banks holding still is in relative terms better. So the dollar has had a little bit of a rebound here, but I wouldn't be so sure that it's got legs necessarily.
Yeah, dollar rebound here. If it sets something up with the RBA this week, they had a really good jobs report a few weeks ago where the unemployment rate was expected at like 4.4%, and it came in at 4.1, which is a stupendous beat. The ECB, we've had officials from Europe talking about how dramatic moves in the currency could upend their best laid plans for how they view their inflation outlook. So maybe if the euro keeps going up, it actually could spark the ECB into cutting rates to help stimulate inflation, so to speak. Could that help the dollar? Maybe, but that's all down the pipeline and theoretical for now. So I'm waiting to see what comes with non-farm payrolls on Friday. That's probably the last big macro event, Ilya. Before we get to that, though, I do want to venture into the world of stocks here real quick, because it's not just macro that's moving the markets these next few days. We do have a bunch of earnings that are out here, particularly in the wake of calendar. In the wake of what were some really, I suppose, disparaging earnings last week for Microsoft. Microsoft and the entire software complex, everything related to that OpenAI flywheel, really had a tough go of things. Oracle is down 7.1% over the past week. Microsoft down 7.65%. You can see Oracle with its 61.4 IVR there on the screen. Palantir was a big loser too last week, down 13.6%. And it's looking a little toppy up here, Ilya, as we go into earnings tomorrow. It's one of several companies with gigantic market caps that we pay attention to, high trading volumes, good options markets that are going to be out over the next few days. Of course, Palantir is a bit of a meme stock. What do you take of this market right now? I know a lot of these individual equity names are starting to see volatility creep up, particularly those in the AI world or those being hunted by the AI world, like a Salesforce or Intuit. Do you have any particular strong feelings for some of these big losers in the AI arms race right now or in recent days as we head into another batch of significant earnings?
I'm looking at this more from the perspective of what these things mean as sentiment indicators. I think the larger issue here is a sense that's been developing really since late last year in the markets that AI has reached a kind of point where it's all but priced for the level of extrapolation that there is to be had. So if we look at even just how NASDAQ has been underperforming relative to the S&P, and certainly underperforming relative to the Russell, we can see that what seems to be going on here is markets basically saying, okay, best case, let's get some rotation. And obviously, there's so much market cap after 2 years, nearly almost 3, of the Mag 7 really being the story, and not just in US markets, but overall global equities. For some reason, there seems to be emerging this narrative that it's run some amount of what's there to be had in extrapolating forward performance. And now we really need to see some sort of a shift in the narrative, or maybe things need to do a little dispersion and capital needs to even out a bit. So I think the larger issue here is maybe not this report or that. We saw that very much on display last earnings cycle. We're seeing it again here, where companies even that report relatively strong results aren't able to keep the overall complex up. So for me, each one of these is an opportunity to see what sentiment for the space looks like. And because the space is so outsized in terms of market cap, what that then means for the whole. I don't think you can really differentiate name by name here. All of them are vulnerable to get caught up in whatever overall equity sentiment narrative emerges from the bunch as a vibe, as it were.
It's interesting that you say you can't really differentiate. On Friday, NASDAQ was down 1.24%. You would think that this was just a big stock name, mega cap stock name, Microsoft's of the world. No, not really. The equal weighted index was down 2.1% there. Right. So it was widespread. It was shared throughout. It wasn't just about the Mag 7 names, although Mag 7 names were down only 0.29%. So again, further pushing back on the narrative that this was about the big guys. Tesla, Meta, they had decent ends to the week. Tesla was up 430, up 3.32%. One of the few things that's making me feel better about the silver and gold at this particular moment in space time. Still holding the short put spreads here. Still feeling good about Meta, which closed at 716 the other day. I still think we have some short put spreads here now at 12 days to expiration because, hey, they weren't really working going into earnings, but then it worked. So happens to work out. I'm going to close this out tomorrow, Elliot. It's at 12 DTE. There's nothing more for me to do here. And certainly if the market's looking a little bit more slippery, I don't want to hold a position that's a winner into a bit of a pullback broadly. But Google is the one that I'm looking at most in terms of the earnings this week, because unlike its counterparts on Friday, this was only down 0.1%. If there was a real scare, if this was not idiosyncratic about a particular segment of the AI marketplace, that's in a particular difficult stretch of time right now, which is really software, then Google would have suffered as well. But it looks pretty good right here. This is an interesting chart to me still. This actually is probably my favorite. If I want to be a stock bull anywhere right now, Google might be my favorite stock. I'm sitting along a 330, 340 call spread in here on the follow account. I absolutely like this position going into the earnings play this week. It has nothing to do with the earnings, of course. It just so happens to coincide with the earnings in the window with which the trade is occurring. This is a great looking chart to me. Momentum is still strong, right? Stochastics are overbought. What more do I need? So if I'm going to try to pick and choose winners here, the top line indexes right now seem to be going through some things. But as we look into the earnings this week, Palantir, Disney Monday, AMD, Merck Tuesday, Google, Eli Lilly, AbbVie, Toyota, Novartis, Novo Nordisk on Wednesday, Amazon and Shell Thursday, Philip Morris and BioNTech on Friday. Google's probably the earnings that I'm most interested in, even if it doesn't give us the highest IVR on the board for some of the names I just mentioned.
Does the sort of, let's call it tepid sign of divergence here? I mean, if you look at the stochastics, you look at the MACD, I mean, I usually look at RSI, they all show about the same thing. There is a sense that there is maybe some divergence in the momentum here. And that might be giving you a sense that, oh, something could be fading here. So if you look at the highs that you're currently testing, you have the January 26th high there around, let's call it 340, 341. And you set a nominally higher high last week, but you couldn't close over that high. And those momentum indicators are giving you negative divergence, suggesting, okay, you couldn't close above the high and momentum's fading. That can be, although it's not sufficient by itself, that can be a topping type of arrangement. Does that give you any pause here?
No, because the market, I feel like it's a period of digestion given what's happening in the top line indexes where the NASDAQ and the S&P haven't really done anything. I just want to quick correction, 340, 350 call spread here in Goog. The fact that we have a crossover here, Ilya, right? MACD is trending lower from January 20th up until January 30th. And during that time frame, all we do is, well, we actually rally during that window. So the indicator digested a little bit of its, overbought momentum or bullish momentum, and the net result was a market that just moved sideways to higher. So it feels like it can stretch its legs again without saying that this thing is too overcooked right now in the short term. That's my view on it. At least that's why I'm still sitting long here. It's one of my favorite setups into next week. Obviously, the silver position, gold positions right now are not working, and I have to figure out how to approach those, particularly on the other side of what will be considered new margin requirement changes. Silver now down below 80, gold down below 4,800. The lows that we had on Friday for each. Friday was a low of 4,700 an ounce in gold. Silver was a low of $74 an ounce. So if you liked it at 117, Chris, you must love it at 74. Okay, what is next trade? We consider, Ilya, what else is on the calendar for the coming week ahead. So we've talked the macro. We've talked what's happening with the earnings calendar here. I would encourage people, if they're looking for high earnings, for example, some of these names, like a Merck doesn't really have it. An Eli Lilly, 38.5. Okay. Philip Morris, 53. Thinner market, though. So be sure not to Hotel California yourself into a position. Pick and choose. I'm not the earnings guy. Tom and Bat and the Batmen tomorrow morning, those will be the people who will delve deeper into the earnings plays for this week. But generally speaking, Ilya, people can go to the FactSet earnings insight report, which is free. I would remind folks if they're interested in reading about this. About 75% of companies thus far for the S&P 500 have reported a positive EPS surprise. Thus far for Q4, 65% have reported positive revenue surprises. The earnings growth rate is 11.9%. It would be the fifth consecutive quarter of double-digit earnings growth for the index. So things are going well there. PE ratio is a little high at 22.2, which is above the 5-year and 10-year averages of 20 and 18.8, respectively. Earnings plays are not my forte, which is why my Google trade is sitting outside the window, which is why I'm not doing 0 or 1 or 2 or 3 DTEs myself. And I'm sure you're not either.
I am not. For me, the most sort of interesting story here still is looking at what all of this situation with oil and Iran is going to be.
Yeah, we haven't touched that yet today. Oil's up 2.7% right now.
Right. So it looks like we're sort of appreciating the fact that no guns went off over the weekend. But just as we had that pullback there along the way, when we initially saw the breakout in crude, and you and I were talking about this, and we said, oh, well, look, here's the pullback on January 15th. That was when there was some rumor mill that we might attack Iran, and then we didn't. And the conversation was, well, does this mean that the move up is over? And I was making the case that no, it's not over because it's not about whether we attack Iran or not. It's about Iran teetering with our involvement or without, and what that means to disrupting the supply of crude oil to China at a time when we are also seizing these tankers that are part of the Russian shadow fleet that transports illicit crude or sanctions busting crude to China at discount from places like Iran and Venezuela, which we've seized, and Russia, the tankers from where we're disrupting. So the whole situation is a longer term narrative than just do we or do we not fire something off at Iran on a given weekend. And if we don't, the narrative doesn't really change. If we do, it accelerates. So I look at this pullback and go, okay, well, we don't get an attack. This is another one of these types of short-term event risk fizzling type of moves, but the narrative remains the same. The uptrend remains intact. For me, a kind of line in the sand here is maybe 62.30, something like this on WTI. And if that holds, that's the swing high from January 14th, then I don't think anything here is anything other than a buying opportunity.
Yeah, the pullback here at the start of this week, oil, I think you and I both went into last week sitting net long deltas. I'm sitting long a short put spread and a long call spread right now. And so with no news out of Iran over the weekend, not shocked that we're seeing a bit of weakness here right out of the gate off nearly $2. Whether or not we don't do anything is another story. So perhaps we have a few days where oil can pull back in and then we, Monday, Tuesday, and then we look into the later half of the week. If you were telling me that this was a war trade coming off tonight, bonds down, gold down, oil down, because there was no Iran attack, I would say that sounds pretty good, but why aren't you telling me about stocks? Well, Nasdaq's off 1.15% now here, Ilya. The S&P is off nearly 0.7%. Do we leave any stones unturned? Outside of gold and silver, which we're going to be talking about extensively tomorrow on air, I have a whole thing on the history of these types of moves in gold and silver that we're going to discuss on Futures Power Hour. I'm also thinking about the non-farm payrolls report on Friday, which, as we have about 90 seconds left here, does non-farm payrolls matter in an environment where the market is not pricing in any rate cuts? Or did Christopher Waller, the heartbroken candidate for Fed chair, did he tip his hand and perhaps some of the feelings among FOMC members in the statement he released last week when he noted that jobs growth for 2025 is basically zilch? Could a bad jobs report be the kick in the pants this Fed needs under a Chair Powell to start really considering cutting rates before his tenure is up in May?
I think absolutely possible, sure. It depends on how bad the number is. Powell has kind of given us a rubric, as it were, that we can use. He's told us, take whatever NFP number you got, subtract 60K, that's the real number. And if that's the sort of back of the envelope math that the Fed is doing, then we can do it too. So we can see whatever number it is, we can subtract 60K and we can say, is this pushing the Fed's average this way or that? Now, in the Fed's thinking, their average sort of for the trend is down 20-ish K. Now, the most recent data, and this is ostensibly what the Fed used to say we need to start cutting rates late last year, was going faster than that. It was approaching down 40K, down 35K as an average for several months. But before that, if you include the entire year, it was less. So I think, yes, this is important to watch. Moreover, I think it's important to watch because these policy expectations continue to be a market mover, and any potential market mover is going to be fraught with volatility because the markets might think it will do something, even if it doesn't. And your sound is gone.
Sorry, final closing thought as we go into the end of this show here. Other earnings seasons recently, when we've gone through them, it feels like they've been in the context of low vol environments. And so you've had the earnings vol crush typically appear on the other side. We're in an environment where volatility is going up right now. VIX futures here closing out their week at the highest level that we've seen since mid-December. You can look at it along the curve if you go out to the March contract as well. The VIX itself, we go out to VIX itself, 1744, but that doesn't tell the story of a market that's pricing in a little bit more risk over the next few weeks and months. But Ilya, that's going to be it for us here on First Call. Programming resumes tomorrow morning, 8 a.m. Eastern, 7 Central Time, with the Batman, Tony, Nick. That's who they are. Tony and Nick. We'll see you guys back here first thing as markets get ready to open for another big week of trading. I've been Chris Vecchio. He's been Ilya Spivak. Hope you have a nice rest of your weekend. Go get some sleep. It's going to be another big one, particularly if you're in gold and silver. So, hey, Ilya, I'll catch you tomorrow. Good luck trading.